Hey traders, this is Blake Morrow with Trader Summit, and I have for the very first time, I have Mr. Leo Nelissen. Good to see you, and good to have you here on the Trader Summit.
Thank you for having me.
It is a pleasure. The pleasure is mine. I want to, but since this is our first time and our first time to have a conversation, tell us a little bit about yourself, and where you're located.
Well, I'm located in Europe, in the Netherlands, very close to the German border. Well, and a little bit about myself. I'm a long-term investor. I work for a company that advises high net worth clients and funds. I write for Seeking Alpha, and I do some other projects on the side, which all focused on advising more or less. And I do invest my own money. It's more on the long-term dividend growth by incorporating macroeconomic trends. So people who follow me on Twitter or just watch other podcasts, it's all about macro and bigger trends and all these things that I follow.
Well, that's great. And I appreciate you being here and being able to talk about some of the big developing macro trends that are out there. And and let's start with like the biggest one. Well, maybe not the biggest one, but one that's probably near and dear to most investors' hearts right now is central banks. And it seems like that most central banks, including the ECB, the Fed, it doesn't matter what central bank you're talking about, any of the G10, G20 central banks have reached a terminal rate or very close to. And from your point of view, looking at like the Fed and the ECB, the two, arguably the two largest central banks out there, which one of these two central banks do you think are going to, what's the direction of them? Are we going to see a convergence of monetary policy? Are we going to see a divergence where one central bank is raising, the other one is cutting? Or, are we going to see cuts? Or where do you think central banks are going to go from here?
That's a great question. And I think you're right. It's probably the biggest question out there right now. The first question I think is, are we at a terminal rate? But I've always been in the camp that expects central banks to be more hawkish than the market expects, and so far that happened. I think even last year the market started to price in a more dovish Fed, which hasn't happened so far. But now I'm at a point where I think we might actually be done. I think the consensus is that we're actually done, that the Fed is done, and the ECB as well, and they've communicated it as well a bit more clearly. Some people make the case that we need one more hike, which is based on inflation re-accelerating again. I think inflation in the US has increased for 2 consecutive months, mainly driven by energy. And I do agree that there is some room to hike even beyond 5.5%. But if you look at credit markets and just the underlying economy, things could be a lot worse, but we're really starting to see some cracks in credit quality. Delinquency rates are going up for pretty much anything. Mortgage rates are doing some serious damage on the housing market, at least on demand. Housing prices are still stable. My thesis that I tell people is I think the Fed could achieve its targets by damaging the economy, but just keeping rates at this level. I think that's all it takes at this point. Just keep rates at this level and just wait a few quarters. And I think at some point the Fed, and I will get to the ECB soon, the Fed will be at the point where it needs to decide, is it going to protect, is it going to fight inflation or protect the economy, right? Credit quality. And if inflation remains sticky, I think that's a big risk that the Fed is going to be faced with some form of stagflation. And to get back to our initial question, the ECB has the same issues. If you look at, I don't have the exact numbers, but if you look at bad debt in mortgages and especially commercial mortgages, Europe is in big trouble. And even worse, 10 years ago, we had the Eurozone crisis, and some of these problems could easily reemerge with elevated rates. So I think the ECB is in a much worse position to fight inflation than the Fed, which doesn't have all of these structural issues that the ECB has. So, if I had to bet on it, I would probably make the case that the ECB is more likely to cut first, followed by the Fed. And I don't know exactly what this cut will look like. Historically speaking, gradual cuts rarely happen. It's more often than not just forced cuts because the economy is too weak.
Yeah.
And I think we are headed for a scenario that way. I'm not extremely bearish, like calling for a new housing crisis like 2008, but I think the risk of something bad happening, what they call the Fed breaking something, they're pretty elevated at this point, and the market is starting to realize that.
It's interesting that you just said, the Fed or the ECB or whoever has to cut rates, they're going to be aggressive, but it will be fascinating, I think, in the years ahead to find out where their comfort level is. Do you think we will ever, let's just assume, let's just and let's look at the glass being half full. We don't have some sort of crisis or another a COVID type of global situation. Let's just imagine that doesn't happen. Do you ever see a world where we have to have rates back at zero ever again, globally? And this is, wherever central banks find zero or close to zero rates.
I think I think that's also one of the questions that will drive markets for the next few years. I mean, Howard Marks had a great memo on this, and he said, since 2009, between 2009 and 2021, I mean, markets had very low interest rates, commodity prices were down. I mean, it was a fantastic environment for tech stocks and all these stocks. But now the question is, will we remain in a period of elevated rates? And that's a big question, right? And I think looking at some of the structural issues, like labor shortages, commodity prices. I mean, for example, oil. The past 10 years benefited from rapid oil supply growth in the US shale, especially in natural gas, and that was one of the reasons why inflation was so low most of the time. And these tailwinds are starting to turn into headwinds. So I think that we will remain in a prolonged period of let's say, above average inflation, above average rates, right? And obviously it will come in cycles. Even if you have a situation where the Fed is forced to cut and ECB, but I think, let's just assume there is an event where they are forced to cut quite aggressively, maybe start even QE, who knows? But I think that would be very inflationary again. You would see something like 2021 again. Commodities go up, speculators start to pump money into the housing market again, and I think that's a very likely scenario for the next few years, that you have economic cycles, but just on a higher level. So I think it depends how bad things go. We could get close to zero maybe, but it'll be followed by hikes again and just above average for the next few. I don't know how long, but that's my thesis, my expectations. But for the next maybe 10 years, who knows? But at least for the next few years.
Yeah, it seems like I kind of agree with you as far as, when the Fed or any central bank for that matter is faced with, do you fight inflation or do you try to support the economy? They're going to have to give up the economy to a certain extent to make sure that they keep inflation under control. Well, let's stay on the topic of inflation, and let's talk a little bit about energy, since you are in Europe and probably a little bit more sensitive to maybe natural gas and some other energy costs as well. What are your thoughts on how this epic rally we've seen in crude oil up towards 100? Now we've seen it back off obviously over the last few trading sessions, really. But this rally that we've seen in energy, how's that going to affect the Eurozone where you're at?
I think we need to break this up, right? We have on one hand the oil situation, which is connected to Europe, but in Europe the situation is natural gas mainly. It started last year, when Russia invaded Ukraine, and they started to reduce natural gas flows to Europe. Europe started to boycott natural gas, and then you had these issues with Nord Stream 1. So I think the situation in Europe is pretty dire, actually. I mean, we were lucky because the last winter was pretty mild, so we had pretty high stockpiles inventories of natural gas, and even before the winter, some companies, food producers, these companies, they started to cut production, and that was actually a pretty big tailwind for inflation. especially in food. And I mean, companies like the German BASF and other chemical companies, they're just looking to move production overseas because it's just not sustainable anymore. And Europe is actually, I mean, it's not only the Russia situation, but also everything tied to the Green New Deal. I mean, my country, the Netherlands, is sitting on the biggest natural gas reserves in Europe, and we don't use it because if we exploit it, it could have an impact on the environment and all this stuff. So they're saying it's just too risky. We're not doing it. We prefer to import gas from the US, Bulgaria, other nations, Norway. But the problem is that this gas is liquid natural gas. So you actually need import facilities, and other nations need export facilities, right? So we are still in a very early stages of the LNG boom. I mean, the US is now, I mean, it started in 2016. That's when it started to heat up, but it's still early. So it's still, I think we need at least 2 more years until we can fully rely on LNG and not having to pray for a mild winter. So that's the situation in Europe, right? And it's just fueled deindustrialization, especially in countries like Germany, who have such major chemical industries. And the worst part is, you know, chemical companies are just at the very start of so many supply chains. So it's not only inflation, but also just a lot of high-paying jobs are tied to it, and it's a pretty big mess. And to get back to your question, in the US, I mean, oil in general doesn't benefit from higher supply growth anymore. All major oil basins in the US are pretty much out of growth, except for the Permian. I think they're estimating the Permian to peak in Q4 next year. And you have OPEC. I mean, OPEC is now realizing that they have tremendous pricing power because the US can't just willy-nilly boost output anymore. So OPEC cut production. Initially, I think they wanted to, it was mainly Saudi Arabia, they wanted to protect $80 Brent. It was quite successful. And then you get news of, you know, demand is pretty high. I mean, China demand is increasing, even though they have, you know, pretty big economic problems in construction and consumer. But essentially, you know, the situation is supply growth is very weak and demand growth isn't as poor as people expected, right? So I say, even with oil at 80 in this environment, just think where oil would trade if you were actually in a strong economy. So that's one of the issues why I say I expect oil. I'm not in the camp of people who expect $200 or $300 oil. I just think it will be a prolonged uptrend above 100. But then to get back to the second part of your question, we had a few very volatile trading days with oil. I don't know where it is right now. I think it's 84 something. It went down like $10 in a few days, which is, I think, a demand scare. You saw gasoline demand in the US is just falling off a cliff right now. And I think maybe we're in the early stages of the hard landing we just talked about, which could do some damage to oil. But then again, you know, once demand comes back, maybe central banks hint at easing, I think oil will be back above hundreds within months. So yeah, that's the situation, right? So it's really tied to central banks and just demand fluctuations.
So, you know, I'm going to leave this with as my last question. You know, we would talk about you just mentioned hard landing. You know, we're seeing China, obviously, their opening and their economy is kind of, you know, didn't do what most economists expected, and China's really struggling and obviously doing whatever they can from a monetary and a little fiscal support, but China's economy is somewhat floundering here. We see, you know, a lot of economies around the globe starting to slow. U.S. is kind of a standout at the moment, and I can just I'll just quote at the moment. But where do you see this as a global economy? Where do you see we're going? You mentioned hard landing. Is that your base case for most economies, or are there going to be certain economies that can weather the storm better than others?
I mean, hard landing is my base case. I think, I mean, regional differences are quite interesting. I mean, yeah, obviously you have countries like India, who are probably firing on all cylinders. But I think Europe and the US are similar, except, you know, the US doesn't have these structural risks that the EU has. I think at some point, maybe 10, 20 years, there is serious risk of the EU, of the Eurozone, not the EU, but the Eurozone breaking apart because of these fiscal issues and monetary issues. But China, I mean, China has an interesting story. I mean, China was the growth engine of the past, 20 years and even prior to that, but especially after the great financial crisis.
Yeah.
People could just rely on China, and Europe did it a lot. I mean, if you look at the German economy, Germany initially started in the 70s, helping China to accelerate urbanization, because Germany is still a powerhouse for machinery and they had the tools for it. And eventually they figured out, China is in urbanization, and they will have a growing middle class. So let's just sell our cars in China as well. And French companies started to sell luxury goods. And I mean, cars are luxury goods as well to some extent. And now this is, I wouldn't say ending, but I know the momentum is gone. I mean, China's construction market is in a very bad spot. And it's also a trust issue. I think, that's also something that I underestimated. I thought that the reopening would be much more beneficial for global demand, which didn't happen. And one of the things that I underestimated is trust in the Chinese economy. I mean, the Chinese net zero policy during COVID was essentially, whenever someone has COVID, I mean, I'm exaggerating a bit, but we need to shut everything down. So that's not an environment you can do business in. So when the Chinese said, okay, let's open up this time for real, entrepreneurs and business owners were like, well, we will see, right? I mean, you're not going to invest billions in a situation where you could be shut down again. So I think that was one of the major reasons why China had sluggish growth they still do. And then the housing market and the consumer weakening. And now you actually see in the past 4 to 5 months that China is really accelerating its exports. For example, car companies, I think it was today that I tweeted a chart showing export sales of a company like BYD, Build Your Dreams, one of the biggest in China. And they are just dumping their cars, affordable electric cars everywhere, especially in Europe. And I think that's one of the moves for China to keep growing, just avoid tariffs wherever possible and just dump, commodity, steel and
I mean, if you look at their currency is quite weak, and that's a lever that they want to pull, and weaken their currency a little bit more to spur exports. Why not? Right?
Exactly, and they're picking the spots where it hurts most in Europe. That's cars. So and they know. I mean, Europe is already in a bad spot because producing cars in Europe is going to be very expensive. EVs are expensive in general. So Volkswagen is now coming out and saying, yeah, we're not, our production numbers will go down tremendously. And Ford in the US is the same, because electric cars are just too expensive, especially in this environment. So the Chinese are saying, okay, we can, because we essentially own the EV supply chain, we can build them quite inexpensively, and we'll just dump them in your countries. And that's one of the issues that countries like Germany and pretty much every country, US, the US maybe to a lesser extent, I think they're better protected to terrorists, but Europe,
correct, yeah,
Europe is in a much weaker spot. So I don't know, to get back to your hard landing question, I think we will see a hard landing in the US, Europe. I don't think I'm an expert enough on China to say how bad their landing will be, but I think growth will come pretty close to 0%. If it isn't at 0% already, who knows the Chinese numbers? India will be in a better place, but that's just because they are, in their own urbanization and middle class growth. And I think it's mainly regional. So when I invest, I look just for secular growth. So that's reshoring in the US. The US is benefiting from companies from Europe and going to the US, and US companies bringing back supply chains, which is a very, very slow process, but it's just something that I incorporate in my research. And whenever things get really cheap, I look for these investments and just put my money there. But in general, I think it's a hard landing in most Western nations.
All right. Well, then, I hate to leave it at that, but I tell you, Leo, I've actually enjoyed this conversation, and I look forward to the next time we get to have this conversation on Trader Summit. As a trader, if you're listening to Leo and you have some comments, make sure you jump down below, comment to him, and let him know how you feel about some of the topics that he'd discussed. What's the best way for us to follow your work?
That's probably on Twitter, where I'm at growth and value. And on Seeking Alpha, where just my name, Nelissen. That's where I publish most of my work. I don't know if it's paywalled. I think it depends on how many articles you view. But that's my public stuff, that doesn't go to private clients. So it's just Twitter and Seeking Alpha.
Well, Leo, I'll tell you, like I said, I really enjoyed our time here, and I want to thank you for spending your time with us here at the Traders Summit, and I look forward to our next conversation.
Well, thank you very much for having me. Interesting question, great discussion. So I look forward to the next time.
Awesome.
And I will make sure, if I watch the video, I will make sure to answer some of the comments if I get questions. So
sounds great. All right.
Just leave all the comments in the comment section. And we'll,
we appreciate you. Thank you, Leo.
Thank you for having me.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.